You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
And now, it's time for the show that breaks down the options market, from unusual activity alerts to market analysis, strategy overviews, listener questions, and much more. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from the Options Insider Media Group, and co-hosts Uncle Mike Tussaw from RCM Asset Management, Andrew the Rock Lobster Joe Vanazzi from OptionPit.com, and Mark the Greasy Meatball Sebastian from OptionPit.com. And now, get ready to hit the option block.
All right, everybody. That rockin' tune means it's time once again for the Option Block, a little show we like to do around here every Monday, every Thursday, live 3 p.m. Central, 4 p.m. Eastern. If you guys are so inclined to join us live, if not, we love you guys joining us after the fact, too, via iTunes or Stitcher, wherever you like to find your favorite podcast programs. My name is Mark Longo from the OptionsInsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. If you say, hey, that voice sounds familiar, you're right, I'm back. I've been gallivanting a little bit of late. Some travel planned, like to the Options Industry Conference. Some travel not so planned, but all of it coming to an end now, so I'm back here. We're able to stream the show live to you again, so if you've been missing the live stream, if you've been sad about, hey, how come we're not getting any live love here on the old show, well, don't worry. We're taking care of you guys for that today. And joining me on the old program today, starting off, let's go. Actually, I'm not sure which one of you is closer, so I'm just going to flip a coin and say it's good old Uncle Mike Tussaw from RCM Wealth Advisors. Uncle Mike, welcome back to the Option Block program, sir. Able job filling in my stead over the past week, sir.
You have some big shoes, my friend. Even though you're only maybe a size 10 or size 11, you still have some big shoes to fill. You're a size 32 when it comes to this show.
Big metaphorical shoes, if nothing else.
Yes.
My metaphorical shoe. Hard to go find those. You got to look at a metaphorical shoe shop. They're hard to find these days, so you got to do some digging when you want to find those sizable metaphorical shoes. And also helping us today, because the Rock Lobster, he decided, get this, listeners, he decided he wanted to spend some time with his wife on his anniversary rather than us. Can you imagine that? So nevertheless, we've got an able stand-in. He's doing triple duty on the network this week. LSFO yesterday, today here on good old Option Block, and good old Twifo tomorrow. So he's loving all of his time in the spotlight. Mr. Nick Howard, the founder of Bantix Technologies and creator of a little platform we like to use around here called Quick Strike. Nick, welcome back to the Option Block program, sir. It has been too long.
Hey, fellas, thanks again. I hope I'm not going to run out of things to say today, so I'll do my best. Glad to be here.
Yeah, Nick, of course, joined us at the big OIC panel at the Options Industry Conference last year, talking about the future of technology. It was really fun. All of you were asking, hey, where's that panel? Nick was just asking me before the show. We put up a lot of OIC content, as you might see. If there are one or two panels missing there, or maybe some snippets missing, don't blame us. It was the folks over there at OCC. Maybe they didn't record something, or sometimes what often happens as well is one or two speakers on a panel may decide their remarks were not for public consumption, even though they spoke them to a room full of hundreds of people. C'est la vie. So we're working on what we can, get you all the stuff we can from everyone who made their comments available to us. So if you haven't checked it out, check it out. Our network feed, probably the easiest way to get all that stuff. Of course, you can also just grab our special events feed for the conference panel audio, and also our interviews feed, our interview show for all of the interviews I did, all my sit-downs with the various people and players and movers and shakers in the space. It was good stuff. And speaking of good stuff, it's time to get rolling with the trading block.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for The Trading Block.
All right, everybody, welcome to The Trading Block. Like the name says, this is the portion of the show where we break down what was trading, what was moving, what was shaking in today's market conditions. Bit of a quiet day on the old street after some tumult last week while I was traveling hither and yon. A little bit quieter day today. Most of the major indices pretty much unched on the day, maybe slightly up, slightly down. S&P almost exactly unched on the day after having looks like about a 7-handle range. So not the most tumultuous of days. And after having a little bit of interesting movements of late, good old VIX cash settling down about a third of a handle to right around the thick 1360 range or so. So a lot of things to discuss. But let's mix it up. Nick, you haven't been on the show in a while, so let's start with you, and let's start in your neck of the woods, because one of the reasons we like having you on the show is you bring a little bit of a different perspective to the program. You, of course, spend your days developing over there on the Quick Strike platform, which has a lot of great futures, options, analytics going on over there. So tell us what's been catching your eye over there. I know soybeans have certainly been lighting it up, so perhaps we'll start there, and then we'll dive into some other products that have really been catching your eye over there lately.
Right. So we've been spending a lot of time on the soybeans market with good reason, right? Because there's been a tremendous amount of activity over there for various reasons, right? We've been speaking about initially early on when the rally started, just to review with some people who may not listen to the other shows, but when the early rally in beans started, that was due to some inclement weather down in Brazil, some rain, which was causing some price increase. And then once people sort of digested all of that information, we got a USDA crop report that started to talk about the limited return on some of the harvest so far. So that pushed another rally out there. So what we were seeing over the last few weeks, we saw some rallies, we saw some pullback, we saw some rallies, but generally speaking, we saw more of a bullish price move on the beans. And then this week, as we were talking yesterday in our CME show, market was down quite a bit for the week, and all of a sudden it was up 30 cents and well into positive territory. So we were testing the highs again in that underlying. And then here we go again today. We're down today. We're still up for the week, but it looks like we're starting to have a little bit of a trend sideways. So as much as people would like to see this thing extended, it doesn't necessarily look, at least we've got all the fundamentals out there. Most of that information has kind of been saturated into the market and absorbed and traded. And now we're waiting to see what happens. But like we always do, we tend to try to look at some indicators of volume and some skew, as well as some put-call ratios. So just to sort of start out there, like we've been talking about all along, front month July has a 29-day expiration, so we could call it a 30-day expiration. So what's nice about that is when we start to evaluate an expiration with that kind of days left, we could look at the contract itself, and then we can go out there and look at the constant maturity information and see what 30-day options have done in general over the period of history that we store, which is approximately 5 years worth of data. So for what it's worth, what we've seen this week in particular, and I'll plug our TWIFO show. We have a report out on the CME site, which will let you look at what's happening in a particular product for the given week, so you get a good idea of where the action is, calls, puts, how the put-call ratios in both the open interest and the volume have been playing out, as well as what a risk reversal of your choice. In our case, we look at the 25 delta risk reversal, again, looking to see what that's telling us about what the market thinks and whether calls and puts are bid. So what we're seeing out there, at least in the front month, there was lots of volume in the downside. So people are playing the rally, trading the rally, but still sort of loading up from a put-call ratio standpoint in the downside from the at the money right now. So right now we're at about $10.80, or the 1080 strike when you look at it on the screens, and big volume in the 1040 puts. And in the front month overall volume, we see puts. We have almost a 25% greater volume in the puts. And same as in the ratio, in the put call ratio for the open interest. So the general consensus overall, not just this week, but still there's a downside bias from open position standpoint. So we're seeing activity, further out, we're seeing more call activity. So August, September, and the new crop expiration November, we're seeing a lot of upside purchases. So even as far out as the 1400 strike in the August contract, and the 1100 strike, which is more or less just outside at the money over in the new crop. So a lot of good stuff going on there. And then one thing that Mark wants me to make sure I talk about is the skew, and where there's some opportunity from that standpoint. So we're still seeing, even from an overall average standpoint over the last year, there's still a lot of bid on the calls. So there's still some trading opportunity there to maybe take advantage of some overpriced or rich out of the money call options in comparison to the underpriced put options. So we're looking at the skew here. It's about a 5% difference in the put and call ratio. But the most important thing about what we're looking at when we look at it from our quick skew numbers is that the calls are priced above the at the money volatility, and the puts are priced below. So that's what we're seeing right now in the beans, Mark.
Yeah, it has been interesting. We know there's been particularly earlier this month, but it's still pretty favorable, as we're discussing on LSFO as well. If you're interested, of course, in all this kind of futures options-oriented activity, of course, check us out on This Week in Futures. Options streams live every Friday on the network, 3 p.m. Central. You can also find it on demand wherever you find all your favorite Options Insider programs. And, of course, also the latest episode of The Long and Short of Futures Options we produce over there with our friends at CME. We got in some interesting research on that side of the fence as well, what's been driving all the tumult over there in the land of the beans. And we were saying at the beginning of the month in particular, but still very much today as well, it has been lining up very favorably for some bearish risk reversals / collars out there. So if you are long the bean futures, you like to buy some pretty close protection, you can do it in the $1 or so out of the money range, and then sell 2 to 3 handles out of the money on the call side, and do that for pretty much even money, which is pretty attractive for a lot of people out there, because those calls were so heavily inflated. They've come off a little bit, but they're still fairly rich from an overall premium perspective. This is kind of fun. We don't usually get the soybean talk here on the old trading block today. We usually, all the commodities we get, Nick, is usually our check-in on the shiny stuff with good old Uncle Mike Tusaw. So let's do that right now. Uncle Mike, what caught your eye in today's activity, as well as what's catching your eye out there in the land of the shiny stuff, a.k.a. gold?
There's gold in them dear hills, and the hills are getting lower and lower. In looking at it, a few things to kind of go through today. Gold is the first thing that's on my radar. Not so much for today. I mean, it had some movement today, but what I think the big news is on gold is after the minutes of the Fed came out saying that things are open to a potential rate hike come June, maybe. When that came out, I think that's kind of scared gold a little bit. It attracted some bears to the gold. So with that, it's been coming down a little bit. From a technical standpoint, I do believe that we're getting near a level of support. Now, this could be considered a triple bottom in some ways. I'm looking at support levels in around maybe the early March, mid-April, and then right about now around the 116 level in GLD, for example. So that's going to be interesting to see if it can hold that. If it does hold that, then I think it'd be a time. I've been selling I got out of GLD probably around the 115 level, and I've been selling puts on gold for a while. So with that, with GLD, what's been happening is that I've been out for a month. I've been kind of waiting for a pullback to happen. So I am waiting with bated breath on that to see if we can close below the 116 level or hold it, or just to kind of see where we're at. Because I do think we're at a pretty nice little turning point for gold, for better or for worse. And it'll be interesting to see where it goes. Market in general, S&P. Andrew and I have been joking on this show the last couple shows about how 205 is like a magnet for the S&P, or for SPY. So with that, it hasn't touched 205 in a few days, so it kind of makes me think that we're due for another 205 in some way, shape, or form. We've been struggling to break these levels for over a year now, so just curious to see if we can continue to do what we're doing. But in the meantime, this is still a sideways market, in my opinion, which I don't think too many people would disagree with me on. So I'd like to see us break above the 210 level, and then I will probably jump more onto the bull train. But for now, what I plan on doing is just continuing to sell some put spreads on dips. But if we break above the 210 level in the S&P, then I'll jump on the train again and start buying some calls. The other thing that caught my eye today Apple is back above the 100 level. So I guess now that it's like Warren Buffett is the new Carl Icahn. So if Berkshire is going to buy Apple, then by gosh, everyone should buy Apple. So maybe there's some innovation in there we do not know about, but nonetheless, the greatest investor of all time sees something in it, and maybe we should start getting back into Apple. I don't know, but until I see the innovation, I'm still going to wait for a little bit before I really push into it with too much. Still have some small positions on it, but nothing of any significance.
I know you were talking on the last show about Apple, I think it was Mark and I, we were teasing you. We were thinking you were going to write some puts down in like the 70 handle level, but you were saying closer to 50. You were really looking for an aggressive, pretty much 50% retracement in the stock before you were thinking about nibbling on some of that. Is that still the case, or maybe you thinking maybe you might write some stuff in the 70 handle range and play with a little bit of fire there?
Oh, I'll play with a small bit of fire. I have Apple. I own some Apple right now. I'm just talking, I own maybe 5 to 8% of, or I'm probably, there's a lot less delta exposure. It's hard for me to give you an exact number, but it's significantly less exposure than what I had back in the old days with Apple, for sure. For right now, at the time being, if Apple innovates something, I'd buy it right now. If they had something to where it was the next iPad, the next iPod, the next iPhone, the next something that would make sense, I'd buy it right. I'd buy it at 140. But I think Apple's more of a stock to where it's more of an innovative type of thing. For now, I wouldn't have a problem doing some type of a wheel trade on it, but the only way that I would get the exposure that I once had on it, if it got down in the 50s or 60s, then I would give some serious thought to it. But in the meantime, what the heck, write some puts on it, have some fun with it, right?
So like par puts, 100 puts, just do it, baby. Just go big or go home, right?
Well, so long as a 100 put, a one lot is not big for you, then I would say yes.
There you go. Uncle Mike said it here first. Sell the par puts, go big or go home, in the literal quote unquote words of Uncle Mike. I may be paraphrasing a little bit, putting a few words in his mouth. But Nick, turning away from Apple for a second, back to what else he was talking about there, which is, of course, gold. Uncle Mike likes to play in the old GLD, which is one of the ETFs we like from a holding physical perspective. Doesn't really tend to suffer from a lot of the problems that a lot of the other ETFs that attempt to replicate commodity positions tend to suffer from a roll perspective. But it is a good one. It mimics a lot of the big futures options. We were saying on LSFO recently that there was a lot of action. People recommending selling verticals out there, buying vertical 1x2s out there, buying one, selling two in gold, because the call skew got so crazy back into the February or March timeframe. I know you have a lot of handle on the skew out there of late. So where are we stacking up now? Is it still super juicy to buy the 1x2s? Can you almost get them all for credits like you used to before? It looks like that has mitigated somewhat.
Yeah, I'm just looking at the 25 delta, or the 25 delta risk reversal, and it's flattening out. We did have the bias over the last few weeks where the calls were still bid over the puts, but what we're seeing now, we're approaching flat again. And what's interesting, and we mentioned this a little bit yesterday, and you guys know better than me, but you do see sort of that teeter-tottering in the vol curve with gold. So we might be, at least from what I'm seeing from a there's a pretty much just like a flat bias on the volume in general, and then the put call ratios in on the open interest, they're below 1, which means there's still more calls open than the rest. But from the skew itself, the skew has been on a steady decline from sort of a 2 or 3 vol credit for the calls over the last few calls that we've had together in the last few shows. So nothing spectacular there in terms of juiciness, but maybe a flip back if we still start to see this downside, because as we were talking about, we have that quick skew indicator that we keep around here, and it does show that gold just have a penchant for going back and forth, sort of the calls switching with the puts in terms of the skew being more in fashion one way or another. So that's what I'm going to this is the first time since we had that around that we are approaching sort of a crossing pattern. So it's going to be interesting to watch what the market's doing and what's going to be required to make that cross happen, and then for that cross to stick. But not quite as juicy as it was, at least not in the front in the shorter dated options. Still a little bit of juice in long dated stuff, but really not that much.
And before we get to the odd block segment, people always write in and ask us, hey, how come you guys are always profiling trades that might be dubious, might be suspicious? How come the SEC doesn't catch these guys, doesn't crack down on them? There are a lot of reasons why that is the case. We've discussed them in the past. Most of their focus is on equities. The options represent the number of enforcement actions they bring, and what percentage of them involve options in some way is still very nominal. So your percentage, just the numbers alone, are in your favor if you're using options, let alone all of the various ways you can obfuscate it if you're kind of slick with options. So there's a lot of reasons why options are still the choice du jour for the insider traders, including, of course, the leverage. But we did see some encouraging news, or perhaps discouraging, depending on how you view it. SEC announcing today they have busted an insider trader using options out of Pakistan, of all places. They say they obtained a court order to freeze the profits of a trader who allegedly manipulated a tech stock through a false regulatory filing that was traced back to Pakistan. This guy, in his U.S.-based trading account, made about $425,000 in less than 30 minutes last fall. The reason I say it may not excite you is because they caught him because he got a little bit outlandish, a little bit of hubris, I think, is what really did this guy in. What they're alleging is that back on April 12th, he purchased 1,850 call options in this particular name, IDT. Let's pull it up here to see if this thing is even still listed. I think this was a Pink Sheet's name at the time. Yeah, it is. IDT trading about 14.5 right now. He paid about $18,000, obviously $500 for those calls, and then and I'm not sure about that amount they paid for him here. That's what they have it listed as, but they don't list what strike or anything else like that. So I'm not sure how savvy they are in the write-up about how much those options actually cost. But then he went on to file his own Schedule 13D, stating that he and a group of investors that had a 5% ownership stake in IDT, and they were going to acquire the rest of the company's shares for a pretty substantial premium. Lo and behold, the stock took off, gapped up. He immediately, no subtlety whatsoever, they immediately dumped out of all 1,850 of his contracts for that aforementioned $425,000 profit. Then files another Schedule D immediately after that saying, yeah, you know what? We don't really own that stake anymore because we sold the options, so we're good. Needless to say, that was a pretty egregious one. That one caught the attention of the SEC, and they cracked down on that guy, and they froze him pretty quickly. So he's not going to be able to get his profits out, even if they maybe have a hard time prosecuting him over there in Pakistan. So he won't at least get the ill-gotten gains of his trade. Kind of an interesting one, Uncle Mike. If Andrew were here, I'm sure he'd have a lot to say on that. Instead, I give you the opportunity to opine on at least someone's getting slapped on the wrist here every now and then, even if it is all the way in Pakistan, and the chances of him actually getting any jail time on this are pretty slim. And also the fact that they didn't really catch him because of the options activity, but more because of the egregious regulatory filings he sent on his own behalf that kind of were a bit of a red flag. But still, I guess that there is some hope there to be mined, right?
You'd like to think. I didn't know that we'd track someone all the way to Pakistan. That's actually something that surprises me, so I guess that's good. I think maybe he needs to listen to the Mark Sebastian episode on how to cheat and get away with it. But the fact that he scheduled his own 13D is actually something that surprises me on that. But what do I know? I've never really done too much insider trading. In fact, I've never done any. But I guess my initial reaction to this is it's surprising in the fact that they were able to track this all the way to Pakistan. But with that, I think it's good that they are cracking down on this stuff. But I'm surprised it made it all the way to Pakistan. That's something that is surprising.
That is emboldening, if nothing else, even though it was his hubris at the end of the day that I think did him in with his false regulatory filings. That 1,800 lot might have slipped under the radar otherwise. All right, since we're on the subject of some dubiously timed options trades, let's get right into it. It's time for the odd block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
right, everybody. That funky tune means it's time for one of my own personal favorite segments. It's time for the Odd Block, the portion of the show where we attempt to find the next of our friends over there in Pakistan and filter out when they're up to no good. Let's see if we can track a few of them down today. Listener is going to kick things off in a realm we've visited before, not this particular ETF. We talked about a lot of WisdomTree ETFs in the past. This time, it's the WisdomTree India Earnings ETF, ticker symbol EPI, closing today about $19.60 or so, $19.60, up about nearly 2% on the day. So a decent upside day here for good old WisdomTree. It's a name that does, about 1,300 contracts, doing about 12,000 today, 657 to 1. Calls over puts. That should give you some idea of what caught our attention out here today, listeners. In particular, it was all the way out in July where we saw this paper starting to light up, where our attention was initially focused. And what caught our eye out there was some love for the July 20s. Again, these are right about at the money calls, a little bit out of the money, about 40 cents or so out of the money right now. Paper apparently loved themselves some July 20s. We saw an initial block going up about 7,000 over there on the SIBO. Paper buying for 45 cents. As the day went on, another about 3,000, 3,500 or so going up. Total of about 10,500 going up on that strike. They went out, about 35 cents at 40 on these guys. So clearly a lot of love for those July calls. No open interest really to speak of, certainly not enough to account for the entirety of that 10,000 lot. So clearly it's open in paper out there in July. And looking here, we didn't see any stock or any sort of other types of trades that would indicate anything else was afoot. This is anything more than it appears to be on the surface. Someone loving themselves some upside here in good old EPI. Looking back over the past year or so here in EPI, and this thing certainly has flirted with higher levels in the past. It hit the 20 level as recently, actually, as back in April. It hit about 2010 or so, 2005, so late April. So not too long ago did this thing flirt with 20, but it was ever so brief of a flirtation, and then it went back down to the sub-20 levels again about a few months earlier, back in February, back in the height of the market tumult. It was trading around the mid-16 handle range there, so clearly there's some downside potential here on the horizon as well. But our friend here choosing to look at the upside back in August of last year, so late summer, this thing was rocking about a 22.5 or so. So there is some potential for upside, but these are indeed slightly optimistic, shall we say, going forward. Let's turn our attention first, since the Rock Lobster is not here to pontificate on all things odd, as he is wont to do. We'll instead welcome on, let's have Uncle Mike here chime in. Uncle Mike, what are your thoughts here on what appears to be a pretty plain vanilla upside call gobbling, to use the technical term, of all things July 20 here in EPI?
Yeah, I'm looking at this, and I don't know what event could trigger that much upside that quickly. So I don't really see this as something event-driven. So in looking at this, I think this is just someone being very bullish. I'm guessing it's not a short hedge. There's always the question whenever someone's loading up on calls, well, perhaps they're short the stock and they want to hedge being short the stock. The reason with which I say that is that typically, I mean, it could be, but I think this is just someone who's very optimistic with what they're looking to do here. So more power to them, and hopefully they can do some type of hedging in some way. What I mean by that is that perhaps if the stock rises rather rapidly, perhaps they'll take something off the table. Perhaps they can maybe sell some other type of call against it in some way, shape, or form. And if it doesn't move, hopefully they get out for their sake.
Yeah, I agree with you. I don't really see, I was looking around a little bit earlier today, I didn't really see any other catalysts floating around out there that may indicate some sort of impending development. Again, that's why we call it sometimes the smart money paper. Perhaps they know something we are not aware of. Sometimes, quite often though, they do not. So bear that in mind. But if you are so inclined, maybe you want to check out EPI for yourself as we roll on in, pun intended, to our next name here. on the old odd block. This is the CurrencyShares Euro Trust, ticker symbol FXE. Closing today right around 109.20 or so, up slightly on the day. It's the name that does about 9,000 contracts a day, doing about 42,000 today, about nearly 17 to 1 calls over puts. Again, that should tell you where our interest lay out here in the good old FXE. It started off, looks like paper coming in and blasting out at the time just under 9,000 of the June 115 calls, and then picking up just under 9,000 of the SEP 113 calls. Doing that for about 3 cents and about 76 cents here. As the day went on, looks like nearly 2x of that paper going up, a total of about 16,000 of these June 115s going up, and about similar amount on the SEP. Total open interest on the June 115s, about 17,000, and the SEPs about, actually, obviously, only about 20 contracts, so clearly open in paper, did about 17,700 total on the SEP 113s. Like I said, looks like they're pretty much selling out of their June and buying themselves some SEP, and went up 2 blocks over there on the ISE. Didn't look like any other chunks of anything else going up, except a 5,000 lot of the 111 calls in September did also go up. So that is potentially interesting. Maybe someone coming in and hedging a piece of the 113s. Maybe our friend here deciding to spread a little bit off. I'll have to dig into that other chunk a little bit. But either way, it's kind of an interesting name. Clearly, our friend here still wanting to keep the call love alive, but doing it, taking advantage of perhaps a little bit of a sell-off here in FXE recently to roll down to a little bit more relevant strike. Instead of the old up and out, this is actually the old out and down, which we don't see that often. Again, perhaps indicative that the initial trade wasn't that successful. This one's kind of been all over the past year, as high as about 112.5 back in just a few weeks ago, and then it's flirted with some lows recently, about 106, and actually back late last year down in the 103.5 range. I don't think these calls were on back then, but still back in March or so, this thing was trading right around 106 as well. So it has seen some lower levels. Been a bit of a vacillating back and forth here in good old FXE. Uncle Mike, I'm not sure if you watch a lot of the CurrencyShares Euro Trust on a regular basis. I know it's one of my favorites. Whenever I start my day, I open up my watch list, FXE, right at the top there, because that's really my market mover. But that said, kind of an interesting thing. We don't see a lot of out and downs very often here on the old odd block. So that in and of itself, perhaps worthy of some note.
No, and looking at, and I actually do like to look at the currencies from time to time. I think it does play an effect on a lot of things. But the original trade was, I think, very optimistic in that if you're at the 115 level, I'm not sure when that was actually when he got into that one. I'd be curious on that. But 115 is a very optimistic strike price. And this is one where either you have to have an iron stomach to do this trade, meaning you can handle the pain. And by iron stomach, I mean you can handle getting punched in it a lot. You can handle pain of getting your booty whooped that badly, and then you still have that trading mentality. The only time I would do something like this is if from the onset I had the mentality that this is something that I would have had to have planned beforehand. If you plan this beforehand, saying, okay, let's start off with the 115 calls, and then if it doesn't go our way, we have some more money set aside to continue this out to September with the lower strike price. If that was your plan from the get-go, then I think that's okay. But in terms of I smell an emotional trader here, meaning that it hasn't gone their way. And someone said, all right, I'll show you. I'm going to buy even more deltas. Even though this first trade hasn't worked, I'm going to buy even more of them, meaning that they sold out of the 115s and are buying the lower strike for longer amounts of time. So whenever we have a roll this way, typically I've never, and I don't know anyone that has ever said, okay, we'll start off with this strike price and then we'll continue on to, if it doesn't go our way, then we'll average down and out another few months with a lower strike price. I don't know anyone who does that. I'm sure it's possible. For every million traders, there's a million trading strategies that exist. But what this feels like to me is someone that's just saying, the euro's got to come up. It's got to come up. It's got to come up. That's what I feel is happening in this trade.
A wee bit of sentiment, a wee bit of emotion at play there. We've seen that before. Wouldn't be the first time, certainly not going to be the last time we see that in the old odd block. Someone liking it at one price, really loving it at another price, and willing to put a lot more money where their mouth is. One last one here. We're kind of going all over the globe here. We started off in India, heading out over there into the realm of good old FXE, aka the euro, and now heading out back here in Canada, in particular, the Royal Bank of Canada, ticker symbol RY, closing today $61.73, up about 84 cents, or a little over 1% on the day. So not a bad day here for good old RY. This is the name that does about 1,500 contracts a day, doing, about 6,400 contracts today. About 15 to 1 puts over calls this time. So that should give you some inkling of where our attention was drawn. In particular, this one was the July 60 puts that caught our eye, going up at first this morning, about 1,800 or so. Paper selling for a nice juicy $1.20. As the day went on, more paper flying in to the tune of about 5,500 on this strike, the latter kind, not getting such great prices, obviously, because the underlying rallying quite a bit. These things went out buck at 115, so that 120 kind looking nice and juicy in retrospect. Total of about 5,500 contracts going up on this strike. That's on open interest of just 900 contracts. This looks like here, most of this went up on the Amex. A lot of it very aggressive, hitting the bid here. So someone really wanted to get in here on RY and taking advantage of perhaps some earnings love. They had earnings this morning before the open, so clearly this player here liking what they saw, maybe taking advantage of a little early morning volatility. Still hasn't shaken out. That balloon hasn't quite popped yet from the earnings event, and so certainly getting some juice there on the 120 kind. I don't have all the prints on the later kind, what he got, but certainly that 120 kind looking nice and rich in retrospect. This is the name that has flirted with some aggressive levels to the downside in the past. So this 60 handle strike is fairly aggressive. This thing was trading back in February about 48, and it got down as low right at the beginning of the year in January, about 45 and a half or so. So this thing could, if it decides to turn pretty far to the downside, and that $1.20 could start looking pretty meager in comparison. That said, our friend here clearly liking what he's seeing here and willing to draw a line in the sand to the tune of about 5,500 contracts here in the July 60s. Mr. Uncle Mike, take us home. What are your thoughts here on drawing a fairly aggressive, fairly meaty line in the sand here on the 60 strike in RY?
Well, if that's the line in the sand with which he desires, then I have no problem with this. This one, at least, is a trade that it makes some sense. I don't feel that it doesn't appear to be one to where it's an emotional Hail Mary pass, so to speak. So if that's what he believes in for that company, then God bless him. Or she.
Yes, important to note. Could be a lady over there. Certainly is feasible this day and age. A lot of ladies out there slinging size on the old desks, and perhaps one of them really loves themselves some RY. Are you so inclined? Do you like RY? Are you disgusted with this trade? Let us know all of your thoughts in the above. Oh, before we roll out, Mr. Howard, I know you like to watch some unusual activity yourself, usually on the futures options side of the fence, but every now and then you get lured to the dark side of equity options. What are your thoughts here on someone blasting out and drawing a pretty aggressive line here in the Royal Bank of Canada?
No, I didn't miss the joke, if you are why, so to speak, and I was muted, otherwise I was laughing, so there was
Longo mutes us sometimes. He misses a
no,
lot of
I heard it.
I missed the gem. I missed the gem. I'm sorry.
It was funny. I heard it. So
I said, if you don't like it, if you are, why?
Right.
That is probably your best joke ever, which is also probably a sad commentary on your humor. That's another conversation for another day.
I walked
symbol humor.
Go ahead, Mr. Howard.
I don't know. Well, I'm just, again, I'm not looking at, I just pull up the charts as you guys are talking about the equity stuff, but I mean, it looks like there was, am I incorrect was there a gap on the open on this stock?
Yeah, they had earnings before the open.
Earnings before you open. So I mean, you never know. I mean, just being in the pit, there's stale bids out there. There could have been size stale bids on that at the on the just one strikeout, or depending how they look at it. I don't know. Did they trade a 61 strike in this, or just a 60? I don't know what the steps are in the equity so much, but
looks like just 60 and 65. That'd be a pretty aggressive stale bid to suck down nearly 2,000 on a stale. That would be painful.
You don't know what. Yeah,
that'd be painful
true,
if that was sitting there. I would take maybe 50 or 100. I don't know if I'd take 1,875.
Right. But if it's 60 and 65 strikes, is that what it is? That's the separation on what's available
in July. Yeah, it looks like that's pretty much what it is across the board. It's not the most liquid of names. So they don't really have dollar strikes out there.
Yeah, right. So I mean, yeah, I get mine is just from a sort of a practical standpoint. You don't think that the gap on the earnings is going to stay, so you come in there and try to punch it down a little bit more. Even though I think the pattern in the moving averages make this thing look like it's a steady to increasing stock. I mean, the moving average is all crossed here recently, so it does have an upside pattern. But see, I have to learn a little bit more about that so I can contribute. Potentially, I don't know what I know in the Eurodollars, 1,000 lot wasn't that big of a deal, So there was a lot of locals in there that would do that, but I guess in here it's much different, given what you got to get out in the stock. So from a hedge standpoint.
Yeah,
anyway.
It's a little bit different size here. I was talking to someone who was slinging Eurodollars today over lunch, talking about 10,000 lots going up on a regular basis. A little bit different out here in good old RY. They do about 1,500 contracts a day, so 5,000, 6,000 is size paper, size money out there. But that's going to do it for the old odd block today. And because it's Thursday, you guys get to take the reins now. It's time to open up the mail block.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the mail block.
All right, everybody, welcome to the mail block. Like the name implies, this is indeed the portion of the show where you guys get to dictate what we talk about here, which is always a scary prospect, but you guys haven't disappointed us in the past, and you usually have some fun nuggets for us to get to. We got a lot of listener questions to get to. I do want to mention we had a few. I was traveling to a chance to check in on our usual options questions of the week. We had a few fun ones going up. Let me just hit on the one from last week first. You guys, Nick and Mike, you can guess along, play along. We asked everybody last week, what is your favorite options trading film? We gave them the choices of Trading Places, Rogue Trader, or Quicksilver, and then they had other in case we missed one. Someone did write in a write-in vote for 9.5 weeks, which I don't think that really is an options trading film. Someone mentioned he might be an arbitrageur of that guy. Either way, I don't really count that one. But so which do you think won? Trading Places, Rogue Trader, or Quicksilver of those three? Nick, you get to go first.
Well, I mean, I could not perfectly, but I still remember most of Trading Places, and so I'm gonna have to go with that.
Turn those machines back on, Uncle Mike. Where do you lean, sir?
I think it's Trading Places, but like I was saying, it's really not a pure option trading movie. So I'll say Trading Places because it's the most popular movie of that bunch, and with the fact that Kevin Bacon claims that Quicksilver was the low point of his career, I'll go with Trading Places.
Does he? I didn't know he claimed that. I thought maybe that TV show he did, The Following, would be the low point because it is terrible. But let's leave that. Leave the commentary for another day. You both are correct. Trading Places wins. FCOJ taking about 70%, 69% actually, of the vote. Rogue Trader in getting about a quarter. Quicksilver only a modest 8%. Yeah, just skip the Vice Messenger scene. Just skip pretty much every other scene of that movie and just fast forward to where he pretty much walks in with the visitor's badge on like earnings day. It's pretty funny. And then one vote, of course, for 9.5 weeks. And really quickly, this week's question of the week, which is still in play. If you guys are following us over there on Twitter, you can cast your votes as well. Coming on the heels of the big options industry conference, we asked everybody, hey, how many U.S. options exchanges will there be at the end of 2016? Hint, right now there are 14. So by the end of the year, will there be 14? We gave you the choice of 14 or 15 or then greater than 15 or less than 14. Mr. Nick, you get pride of place again. First off, what is your vote? Then B, what do you think is actually winning the poll?
My vote is greater than 15, and my vote would be 15. My vote's 15. I would guess that people say 15. And I have one orange juice comment. Today's volume in orange juice front month was 343 contracts. So Eddie Murphy traded more contracts in that 1 minute that was in the film than all of today traded in all the contracts.
FCOJ. I did listen to the commentary on that film a few years ago, and Eddie Murphy's commentary on that scene where he pretty much admits he had no idea what he's doing. And then I watched that scene again now in retrospect, realizing that, and it is pretty funny because he has no idea what he's doing. Watching Eddie Murphy in that pit scene towards the end of that movie, it is fantastic if you've ever spent any time in a trading pit or have been so unfortunate to do so. So Nick gets the 15 vote. Mr. Uncle Mike, what is your vote? And B, what do you think is winning?
Greater than 15, greater than 15. More exchanges. We need more and more.
Interesting. All right. So, my vote would have been probably actually maybe on the less than 14 side. Because I think NASDAQ may shut down some of those ISE exchanges that they bought before the end of the year. But, of course, MIAX is adding an exchange, so we will be at 15 by the end of the year, which is probably be the winner if nothing else changes before the end of the year. But actually, the winner right now is actually less than 14. So a lot of people leaning with me. About 54%, of the votes saying there will be fewer than 14 exchanges for the end of the year, 29% for greater than 15, 17% for 15, 0% for where we currently are at, which is 14 options exchanges. Kind of interesting. Everyone expecting a little bit of vol before the end of the year. We're going somewhere. We're not staying here, as they say when they kick Uncle Mike out of the bar at the end of the evening. All right, let's move on to some of our listener questions. Before we even get we got a bunch of people who wrote in, but we got someone chiming in here, and this one makes me laugh, Uncle Mike, so I'm going to give this one to you right away. Coming in on the live chat, we got a question that is right up your alley, Uncle Mike. This comes from Ms Fidious. Ms Fidious, I'm not sure if I'm pronouncing that right. If I'm not, blame Uncle Mike, not me. He wants to know, or she wants to know, Uncle Mike, what the heck is a stupid? I'm not sure where they got that from our conversation, but maybe this is you typing this into the chat room. I don't know, but it's kind of funny. It made me laugh, so you get to answer it, Uncle Mike.
All right, Ms. Fidious, first off, let me preface this. You need to go back to a show. I don't know what show number it is, but if maybe there's got to be a way that you can type it in to get it on the website. I'm not sure, but we had a big debate about stupids, and it came down to it to where it was determined on the show that 90% of all traders trade stupids, and the other 10% lie about doing it. So with that being said, a stupid is when you buy an option and then buy another option at the same time. So an example would be you would buy, let's say the stock's trading at $30 a share, you would buy the 30 call, and then you would also buy the 35 call as well. It got the name stupid. I don't know how it got the name stupid, but I guess everyone thinks it's a stupid trade for whatever reason. So it's just when you're buying on both sides or buying at different strike prices at the same time. You're not doing a spread. You're not doing anything like that. You're just buying a 30 and you're buying a 35 call at the same time, or also for a put. We've debated on shows of the uses of the stupid way more than I've actually talked more about stupids on this show than I ever have spent time trading them. Thank you, Mr. Longo. But I have one specific use that I use on the stupid, and I do talk about it in my book, which, by the way, is available on Amazon. Go Long, New Option Strategies for Buy and Hold Investors. You can buy it for your Kindle device for $2.99, by the way. But it's just kind of like a weird little tool that I use at times. But in general, it's not a very common trade, and how it got its name, that's a bit of option trading history that is before my time. I didn't even know it was a stupid until Mark Longo told me it was a stupid.
There you go. It's very aptly named strategy in my tune in. Just do a search on our site for stupids. You find all the episodes. We've debated that ad nauseum. I should amend to that. You can also sell stupids. You don't have to just buy. You can sell two strikes, something like that. So it's not only the long premium traders who get to be stupid on occasion. Good question from Ms Fidious, aka Uncle Mike's mom. We move on to let's see. They're chiming in here. They say it does indeed sound fairly stupid. Well, there you go. They agree with us. Let's move on to some people who took the traditional route, starting with M Davis 82, saying, "Hey, I just started listening to the show." Well, first off, welcome to you. Then in one of the first few shows, it was mentioned that you can use selling of options to, in essence, create a dividend on a non-dividend stock. Is there more information about this laid out somewhere and puts in parentheses, puts, calls, how far out, what strike price, what if underlying goes up or down? Thank you and love the show. Well, we only got about 10 minutes left in the show, and this is a topic that is of some density, so we'll attempt to condense it. Maybe we'll spend some more time on some of our other shows. A good thing for you, M. Davis 82, is that we've touched on this many times on this program and on other programs on the network. In essence, anytime you're writing some sort of options premium on a stock position like a covered call, you are therefore creating your own dividend income stream on that name. It doesn't have to be a specific strike or at the money or out of the money or anything like that. And in terms of, so once you start doing that, you have an income stream, you created your own dividend. Bam. It's just that easy. How you do it, that really, that gets into a lot of specificity, depending on the name, what you think in terms of your outlook for that name in the near term and the longer term. Maybe if you're not that bullish on it, but you want to hold on to it for some reason, maybe you write a little bit closer to at the money or maybe even at the money, or sometimes people who are pretty aggressive on covered calls like to write in the money to capture that put wing premium you get on the call wing in there. So there's a lot of ways you can go about slicing this particular and dicing this particular cake or pie, but it's an interesting one. What if it goes up and down? We talked about this, how far out. We've talked before about you want to try to concentrate your liquidity somewhere on the nearer portion of the expiration curve. So monthlies, if not weeklies. We've had some interesting conversations on this show and Vol Views and others recently about some data coming out of the SIBO conference and others about the efficacy of trading weeklies versus monthlies. I encourage you to check out those studies to see if that makes sense for you. 4 contracts a month versus 1, more commissions, but the premium you're going to harvest is also going to be more. What if the underlying goes up or down? That gets back to your own rules about adjustments and things like that. There's so much to fit in this. We can really only touch on this on the surface. Uncle Mike, I know you talked about this before about 15,000 times on your strategy block. Anything you want to add to M. Davis 82, who sounds like he or she is kind of new to the whole call writing or put writing or whatever case, income harvesting portion of options trading?
Yeah, let's break it down to the simplest form, a covered call. You own a stock, you sell a call against it. You're selling an obligation. So the income, no matter what, the stock goes up, down, or sideways, that income is rightfully your property, no matter what, right there on the spot. So if the stock is trading at $50 a share and you sell the 55 call, that's yours no matter what. Now, the difference between selling a call, or selling a put for that matter, and a dividend is that when you're selling an option, that comes with an obligation. The dividend does not come with an obligation. Now, in the dividend, you don't get the guarantee of income because they can cancel that dividend up till whenever they want, basically. So you might, even though the stock says, hey, we're going to keep paying this dividend. We're going to keep trying to pay this dividend. And then all of a sudden they have a bad quarter. Whoa, we're not going to pay this dividend anymore. You're not guaranteed the income. Whereas if you buy a stock and sell a covered call against it, that money is yours to keep now, always and forever. It's yours. Now, the difference then is that there's good and bad to both. At RCM, we have our triple income strategy to where we sell covered calls on dividend-paying stocks or short puts to get into dividend-paying stocks. So you can look to do that as well. But the main difference is that dividends are not guaranteed. They can get canceled at any time. And selling options is guaranteed. So that's kind of where you can favor selling options or selling covered calls. Now, the dividend favor is that you have no obligation with dividend. Apple pays a dividend. And if Apple goes to $300 a share, then you still get to keep those dividends all the way up. However, if you sell the 105 calls on Apple and Apple goes to $300 a share, then you have the obligation to sell Apple at 105 per share. So the benefit of dividends, there's no obligation involved with them. Disadvantage is that there's not going to be a guarantee that they're going to be paid. Advantage of options, that's your money. It's guaranteed. The disadvantage, there's some type of obligation involved. And that is my thought on the matter.
Indeed. I know, Mr. Nick, before we roll out, you have some comments on this as well. What are your thoughts here for M. Davis 82? Well, yes, go for it.
Well, Uncle Mike certainly got more experience doing covered stuff. Our covers were usually delta neutral coverage when we were trading them. But just from a practical side, if you own a stock, say you own a $50 stock and you're perfectly willing to sell it at 55, why not sell the 55 call? Therefore, you're responsible for selling that selling that stock to 55 to the people, but you're also getting the benefit of the dividend return by selling the premium on that strike. So it's a little bit different in that you're going to have to, dividend, you got to own the stock, right? But if you own the stock and you sell a call, you're going to have to deliver that stock. So you're really collecting a dividend without ultimately owning it if it does go through your strike. Now, if it doesn't go through your strike, obviously you get to keep that premium. And if it goes just short of your strike, you get to keep that premium and you still have the appreciation of the stock itself. So there's a bunch of different ways you can look at it. But as Uncle Mike said, you're always going to end up having to deliver that underlying to whoever you sold the option to. So that's just the thing to keep in mind. But when I say it out loud like that, it actually sounds pretty good. You buy some undervalued stuff, think where you'd be happy to sell it, and sell all the. Now I might do something even more. I might sell a call stupid against it, right? If we go full circle.
We lured him to the dark side.
I'll say we did lots of call stupids in the options pit.
The truth comes out even more.
That explains why I never traded in the euro dollars. All those stupids going up there was too deeply offensive to me.
No, and I think
specifics of the trade. Longo's going to give in and say, "Okay, well, I do it that way." That's what he always does. He always comes out with this big wall against the stupid. But then if you talk to him a little bit, then he kind of likes it. And then if you go out and have a few drinks with him, good gosh, he's ready to do a whole stupid webinar.
I can't stop talking about the stupids. No, outright stupids, I'm still against. The rolling kind of momentum stupid, I can see a use case for. And as I said before, and once in a while, maybe if you want to maybe spread your deltas a little bit, it has some sense to it. But even still, I think the efficacy of doing that
now that's a new one.
Is overstated.
More every time.
That's the same one as before. That's the one we've always. I think the efficacy of doing that is overstated. I think you'd be better off keeping your liquidity on one strike. But again, this is a debate we've had many times. Uncle Mike, he shan't win it today. But it sounds like you've lured Mr. Nick to the dark side. So I'm just going to mute him really quickly as we move on into our final segment. Yes, it's time for Around the Block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
All right, everybody, welcome to Around the Block. Like the name implies, this is the portion of the show we tell you what we're keeping an eye on for the rest of this week into the old weekend. It's kind of a bit of a quiet time in the old markets. Not a heck of a lot of earnings still coming down the pike. Everyone's kind of playing the wait-and-see game with the Fed coming up in a couple of weeks. So that's kind of, I think, was on most people's horizons. That said, hopefully Nick's shaking all the stupidity out of his stupid love out of himself there, and he can instead tell us what's catching in his eye, what is he watching for the rest of this week into the old weekend. Could be some indicators, could be some trading activity in some particular products. Nick, what's catching your eye right now there, sir, and what are you watching into tomorrow and the weekend?
For the record, this is a true story. I believe Chuck Levine from the Eurodollar pit called it because when you do a stupid, you point at your head and you pull a trigger. That's what it's called. That's how the symbol for the stupid in the pit is. You say 35, 37, 40, call stupid, and you point at your head and shoot. So that's the symbol because you got to be stupid to be doing that trade.
There you go.
Going into the weekend, it's just looking at these ag markets that are sort of bouncing around their high marks and to see what happens today and tomorrow. Well, it's closed, but I'm not paying attention to what happened to close. See what happens tomorrow, which will give us an indication of what we think is going to be the follow through for next week. And then the topic that we didn't get to touch on that was in the notes was the Brexit conversation. And if anybody gets any time out there and you go out and look at the pound skew, there's a really, really big skew to the downside in the pound. In anticipation of the Brexit vote. So those are just things to keep an eye, some stuff to keep an eye on, and as we approach that vote coming up here, and again, as far as the FOMC next month, not a lot of craziness going on in the rates market. They see a lot of people selling strangles, or paper selling strangles, which means they don't think much is going to happen in the middle part of the yield curve. So that's about all I have to offer for that stuff.
It. Pound skew, probably two words that have never been uttered together here on the old Option Block program today. Nick bringing new and fun markets to us. Uncle Mike, what's catching your eye for the rest of the week, sir, into the weekend?
I think the Brexit is definitely something to watch. With Andrew and I had talked about British bond yield option skew. We had a conversation on that on the previous show, which I think that's probably been a first, which I remember saying on Monday, too bad we didn't have the Viceroy for that one, but I think that's something to watch. Non-farms coming up, and the age-old debate is going to play out now. Should we sell in May and go away? Going to watch that, and then seeing if we can bust through this 2100 mark on the S&P.
All right, listeners, that music means we've come to the end of yet another exciting episode of the Option Block. But before we go one last time, let me check in with each of my cohorts here on the old All-Star panel. See what they're cooking up that may interest you. Let's start with you, Mr. Nick. I know in addition to the big This Week in Futures options coming to you live every Friday, 3 p.m. Central. I know our schedule got a little bit wonky with all my travel lately. We did it on a Thursday last week and everything else. But don't worry, it's coming back to you live at its usual time, Friday, 3 p.m. Central. You'll be getting it on the following Monday on the old network. So give people a little taste of what we're going to talk about there, Nick, as well as whatever else you got cooking up in the land of Quick Strike that may interest our audience.
Well, tomorrow, I think, again, we'll just see how the beans finished out the week, and we'll talk a little bit. We didn't get a chance to do it today, but there was definitely some unusual activity in the Treasury market. In the 10-year in particular on the upside, and then in the 5-year, some big openings on strikes on the downside, and both of them about 1% away from the at-the-money in terms of overall yield. So we'll be looking at that tomorrow. And as far as new stuff goes on, I say the same thing I always say. If you have any interest or want to take a look at some of the reports, go out to the CME Group site. There's a lot of stuff out there for free. And search for Quick Strike, QUIKSTRIKE, and you'll find Quick Strike Essentials, the free version, as well as the other tools that we have up there available for you to look at the futures options market.
There you go. And last but not least, Uncle Mike, what's cooking in the land of good old Uncle Mike?
Well, of course, if you want to learn about the good old stupid, feel free to buy my book, as I described earlier. But also, if you are interested in working with a financial advisor who does tend to delve into options, or at least not think that they're the evil of the world, and I think they're actually pretty good, feel free to contact me. Even if you have $50 or $100 a month to invest, I can work with you. I am at 312-212-3531, or send me an email at mtusaw@rcmfs.com.
All right, that's going to do us here on the old Option Block. I want to thank all of you for tuning in, for downloading, streaming, and subscribing, whether it's live or after the fact. We love you all. And we'll see you next time for more of the Option Block.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.